Welcome, everybody, to the first Wealth Wednesday with Cashflow Architects. I'm Matt Love, and stoked to have you here. If you're watching this on YouTube, it's good to have you here. This will be part of a playlist for all of the Wealth Wednesdays, and I hope to bring a lot of value about the financial world and hopefully debunk some of the myths that are out there. And the intention of the meeting really is to be educational, entertaining, and be able to answer some tough questions. So if you have questions about, how life insurance works and debt or retirement plans, please ask away, because this is the point where, all the cards are on the table. So welcome to the first Wealth Wednesday. We got a good guest here in Lance, who I've spoken to a couple of times in the past. I have a quick presentation that I put together. I'm doing a presentation to an investment group, and we're talking about how to set your money up so that you can invest and still keep control. And the title of the presentation is called Debt, My Second Favorite Four-Letter Word. And I'm going to go over why I think that. So there's going to be four parts to this. Number one is how to short the American dollar. So I'm going to talk about how to short your cash and why that's important. I want to talk about other people's money and rate of return, hopefully debunk some myths around the idea of debt. Sorry, Dave Ramsey. Number three, I want to talk about how to control your assets so that you're not exposed in lawsuits or too much opportunity loss. And finally, I want to show you how to give you and your family a permission slip to invest over and over again before retirement years. How's that sound?
Sounds fantastic.
All right, cool. I'm going to pull up my screen here. I'm going to share my iPad. All right. So shorting the dollar. What do I mean when I say short the dollar? Inflation is going to happen to every single person who does a transaction with the United States dollar currency. And inflation is the idea that the value of my money is going to be worth less in the future than it is today. And so inflation is going to either help or hurt every financial decision that you make. Now, if you believe that inflation is true, you want to pay attention to this, because there's a reason why people talk about savers are losers. You're losing by saving dollars because the value of the dollar is going down, hopefully at a rate that's smaller than the growth of your account, because the idea in 20 years from now, my $1,000 is not going to go buy as much groceries as it does today, 10 or 20 years from now. It's going to buy much less. So I need to get that rate of return inside of some savings vehicle like a 401k or an IRA to just make up for what inflation is going to take away from me. So if I know that the American dollar is going to be worth less in the future, how can I leverage that? My second favorite four-letter word, debt. I'm going to short the dollar by going long on debt. Now, there's different characteristics of what makes good debt. Ideally, we have a low interest rate. Ideally, we can do this in a way that the IRS incentivizes, where I can deduct the interest rate that I'm going to be paying to a lender. Hopefully, it's a long guaranteed loan that's guaranteed never to change. And number four, I want to buy an asset that ideally will go up with inflation. What does that describe? What kind of loan could I get with a low interest rate that's guaranteed never to change for a long period of time? I don't know, maybe 30 years on an asset that could go up with inflation? Hello. Mortgages. So how I buy my house is a great example of how I can short the dollar. Okay. I heard a great saying the other day. The guy said, look, if you're worth $1 billion and you just want it to maintain, go put it into land. Go buy a huge piece of property, cash. If you want to, because if you kept the $1 billion inside a bank account, it's going to be worth crap in 30 years. But if you buy land, there's only a finite amount of land in the world. They're not making any more of it, and it goes up in value, historically speaking, over time. So if I want to make $1 billion, I go buy land with other people's money. I put the smallest amount down, I buy land with other people's money, and then I pay debt service on the land as the land goes up in value. What happens to the value of my payments that I'm making to the lender? They go down. So think about this. Let's say I have a mortgage payment of $3,000. Okay. We can talk about principal and interest and all the HOA, whatever. Just it's $3,000 a month in order to carry my mortgage. Okay. And if I have a loan for 30 years, that's equal to 360 payments. So I, the borrower, can print off 360 checks for $3,000 and stack them on my edge of my desk here. And every month I pluck another check and I send it to the lender. Lance, what's happening to the value of that $3,000 as the loan over time?
Well, it's dropping.
It's dropping.
Yeah.
It's going down in value. So let me show you exactly what I mean by that. If I have a check today that's written out for $3,000, what's a good inflation rate? What do you think is fair on average over 30 years?
Well, 3%.
We've seen exceedingly crazy inflation rates in the last few years, 7% up to 7%. So I think that's a very conservative rate, is 3%, but that's what the government tells us to be true. So let's just say it's 3%. So if my interest rate is -3 over 30 years, the value in 30 years, the value of my $3,000 is equivalent to about $1,200 today. So I'm using deflated dollars to pay off a loan over time on an asset that is theoretically going to go up in value during high inflated periods. What happened to the housing market since the inflation's gone through the roof?
It's gone through the roof also.
It has, because it's a hard asset that I can see and touch, and those things then it's finite. Those things go up during inflated periods of time. So I can short the dollar by using other people's money on a guaranteed loan that the IRS incentivizes because they allow me to deduct it, buying an asset that's going to theoretically go up in value over the next 30 years.
So I guess I should get out of life insurance and get into real estate.
I think that you're halfway there. However, it's not a question of either or.
Right. I get it.
Once we apply these principles, then it's how do we make it happen? So I'm going to go over that before the end of the meeting, though, too. I want to show how to use life insurance, because the truth is, I don't want to not participate in real estate. I want to use life insurance in order to participate in real estate.
Exactly.
Okay. And the life insurance is not in lieu of the real estate. It's an addition to.
Right.
And what I'm going to get rid of, though, is the banks. I do not want to use banks. And we'll cover that exactly why here in a second.
Okay.
I'm going to go back to my iPad. So let's talk about a loan rate. If I'm earning 5% in an investment, and I have a loan at the same rate, is that considered a wash?
Well, and what we're talking about, it's better than a wash, because that those dollars in the loan are going down in value, and the 5% is compounding upon itself, right?
You're exactly right. So so now that we understand inflation is going to happen. I know that debt makes sense if I do it correctly using good debt. Now let's talk about just strictly numbers in this year. Let's say I have $100,000 and I'm compounding at 4% for 10 years.
Okay.
And over here, I have a loan for $100,000 at a 5% interest rate for the same 10-year period. Now, just looking at the dollars without looking at inflation, is the dollar amount that I earn equal to, less than, or more than the amount that I'm going to pay the lender?
It's more, because it's compounding upon itself.
Exactly. Most people say, look, if I'm in debt, I'm paying 5% and I'm only earning 4%, I'm losing value. And this is the problem that I have with so many people that don't understand debt. It's absolutely wrong. Because an amortized loan, I'm paying interest each year, then I'm paying less and less as the time goes on. I'm paying less interest over time. We've all seen amortized curves, whereas compounding, interest can earn interest. So compounding beats amortized loan interest almost every single time, unless there's a huge disparity in the rates.
Yeah. Can I ask a question, Matt?
Yeah.
So on your typical 30-year loan, most of your interest is in that first 7 to 10 years. Are those amortized loans? Typically?
On a mortgage?
On a mortgage, yeah.
Yep.
So well, then I'm sort of confused because I thought when we talked about amortized loans, when we start paying off an amortized loan, where the future payments are, the payment remains the same, but it's paying off more principal each period, isn't it? Or something? Maybe I'm confused.
In the beginning, you're paying more interest.
Yeah.
And less goes towards principal. That's why in a true amortized curve loan, it's kind of flat at the top, and then it starts to get steep towards the bottom. Because in the early years, you're paying more interest than you are to the principal, which is with a deduction. In other words, you get a larger tax deduction.
Yeah.
And the loan outstanding balance is still fairly high.
Right. Okay.
Yep. So the $3,000 in that example that I gave, a portion goes to interest, a portion goes to principal, and I can show up a calculator there that shows in each year how much you're actually paying in interest, and that amount of interest each year actually goes down, which makes your deductible, your deductions go down in those years as well. And so what people don't like when they look at a loan is like how much interest they're going to pay over the lifetime of the loan. Well, very seldom do actually own a house for 30 years, but when you look at keeping the debt, once you understand inflation, yes, I'm going to pay a lot of interest to the loan, but if my money can be earning compounding elsewhere, I'm going to earn a lot more than what I would pay inside the loan. So in this example, compounding 100 grand at 4% for 10 years, I'm going to earn around $48,000 of interest.
Mm-hmm.
And on the right hand of the loan, I'm only going to pay about $27,000 of loan interest. So
Right.
so theoretically, this could be the deduction over that time frame, but this is the amount that I've earned. So when they say, because what Dave Ramsey would say is avoid this trap because you're going to pay $27,000 of interest. Okay,
Mm-hmm.
I'll avoid the interest, but what did I also give up? If I paid cash, I avoid the interest. I've also given up the growth of $48,000. And here's the big thing: solvency is more important than being debt free, and this is where Dave gets it wrong. Because he went bankrupt when the banks called all of the loans on his properties and he was insolvent. He couldn't make the payments. And so he went bankrupt. And that's why he hates debt. Well, if I have the ability to pay off the loan, in this example, I have 100 grand. It's going to make sense for me to keep the $100,000 compounding and take on the debt because I'm going to earn more than what I'm paying. And if the bank calls the loan, hello, I have the cash to pull it off, to pay it off.
Yeah.
Okay. Now, the part that I don't like is that is a bank, today it might be, but historically speaking, is a bank actually paying 4% in growth and interest?
No.
No. And if they do, it's also taxable.
Yeah.
Right.
Yep.
So now what I've just proven is that number one, I want to go long on debt because the value of my dollars are deflating. I can short the dollar. I'm going to use other people's money to buy an asset that can go up. And I'm going to prove it makes sense because of if my cash is sitting somewhere that can compound, I'm going to earn more than what I'm paying by taking on that debt. Does that help?
Yeah. Yeah.
Okay. Now, when I make income, we're going to talk about controlling your assets. When I make income, what do people typically do when they get a paycheck? Even if they get a paycheck, or it usually just gets direct deposited into what?
The bank.
You got it.
Yeah.
Checking account, which historically speaking has been a crap rate of return.
Yeah.
And even that return that you do get is taxable. And more importantly, it's exposed. I used to joke, I don't care how much money you have, I care how much you can lose if something happens to you. This is why GoFundMe exists, because when problems arise and people lose everything, they have to start over. Just avoid the massive failures in life, and that will help you get ahead. And if this money is sitting in the bank, if it's exposed inside of a lawsuit, if it's just in a personal savings account.
Yeah.
Okay, there's very little growth. The little growth that you get is taxable, it's exposed in a lawsuit, and there's no other benefits. The bank likes you a lot. You might get the concierge service. Some of the big banks will have a concierge service if you have a bunch of money in a savings account. Why? Because what are they doing with our money?
They're investing it.
And they're lending it out.
Oh, yeah. And lending it out. Yeah.
So when banks lend money, are they lending their money or somebody else's?
No, they're lending theirs. It's still what, 10% or something they call it.
Yes. So it's fractional reserve lending. They're doing the exact opposite of what the financial entertainers teach us to do.
Yeah.
So what I want to do, instead of going money into a bank and then going to an outside investment like real estate, and this is where I want to generate my cash flow. And I also want to have a mortgage on this thing to pay for 80% of that. Instead of putting money inside of a bank, this is where life insurance comes in. Life insurance is not in lieu of real estate. It's a stepping stone to get the real estate. Why? Because I actually do like my kids. And I want to take care of them and my beautiful wife. That doesn't depict how pretty she is. But I have a family of 5, and I want to make sure they're taken care of. And why I do life insurance is because it buys this really big thing called a death benefit. I know that they're going to be taken care of. Is the rate of return in life insurance amazing? No, it's not amazing, but it sure as heck beats what a typical bank savings account is doing. And it's not taxable. And it's protected depending on where I live. As long as I don't live out on the left coast. And there's a couple other states that you are exposed in life insurance, but where I am in Tennessee and where I come from, Michigan, you don't have to disclose your cash value life insurance. It's hidden. It's off the radar screen of the IRS, and it's off the radar screen of creditors and predators.
Yeah.
And I get these really big benefits for my family in case something happens. So now I have what? I have a permission slip. I want to go buy the Lamborghini. I can go buy the Lamborghini because if I die tomorrow, my wife gets the Lamborghini plus whatever's left over inside the death benefit. But I don't want to go buy a Lamborghini. I want to go buy cash flowing assets. Why? Because the IRS allows me to deduct the cost. I'm going to short the American dollar by going long on the debt on a hard asset that goes up in value. And what do I get? Cash flow. Now, right now, it's not super attractive to buy real estate, but wait 5 years. It's not going to get any better. So right today, it's more of an equity play than a cash flow play. What I mean by that is when I have equity in the house, right now, if I were to buy a house, the prices are really high.
Yep.
Right. And so the rent that I can get from the property probably is just going to do enough to cover the mortgage, maybe give me a little bit of cash flow, but that might even go back into the house for repairs. When you spend money on your investment property, are you allowed to deduct the costs?
Yes.
100%. Yeah. It's the cost of doing business. It's in an LLC if you do it correctly.
Yeah.
So it's not a huge cash flow play now, but in 30 years, you think people are going to want to sleep inside?
That's a good one.
Yeah. I'm betting yes. I think they're going to want to sleep inside. So I'm bullish on real estate, even as an equity play. And let's be honest, you have more fun talking about a rental property on a lake or a statement that you own Netflix stock in?
That's a good point too. I haven't heard that one.
Yeah. And so anybody's interested in this idea, I have a website. It's called 401cottage.com. 401 Cottage.
Oh.
And it's the idea of instead of funding a 401k or a SEP IRA as a business owner, I want my family to enjoy and use my retirement plan. Because instead of statements, I'm going to get keys. Instead of stress of the market, I get memories with my family. And so 401cottage.com, there's a free ebook you can download. And it tells you all about why that makes sense.
Sounds good.
So does this make sense? Now, we went over shorting the dollar with debt, why other people's money it makes so much sense because my money can continue to compound, using life insurance to control my assets, and it gives me a permission slip to spend all of my dollars. Does that help so far?
Yeah, it does. It does.
Cool. Any thoughts or questions before I keep going?
Yeah, the only concern I would have is with real estate. I mean, it does take, if you own the property outright as opposed to some sort of real estate investment trust, or there's a couple other names for shared investment, real estate investments. I can't remember what the names of them are, but it seems like maybe investing in some sort of REIT may be a good move, because then you don't have to maintain it, right?
Well, I'm glad you brought that up. REITs were really popular for a long time. The challenge is, do you get a 1099 or a K1 with a REIT?
Oh, I see. Yeah. Yeah. But I think there's another structure where I think you do get I think you do get the tax benefits somehow. Anyway, I don't know enough about it.
Well, in a REIT, a REIT is an investment. You're going to get what's called a 1099, which means it's taxable income.
Okay.
And you're not necessarily an owner, where you don't get the owner depreciation and deductibility of the cost of ownership. What you do get is passive. Ideally, it's a passive investment where you don't have to find you're not the one changing the toilets. You're not the one finding renters. So there's definitely value there. I'm not saying one is better than the other. They're just different.
Okay.
And for people who want to get involved, I think that's not a bad idea. A REIT, I would probably lean towards, well, what I did was go join a syndicate.
That's what I'm thinking of. I think that was the term. Yeah. So what's the difference with syndicate?
I'm an actual owner of the property.
Yeah, there you go.
And I get a K1 at the end of the year. And we did, I put $100,000 into this big short-term rental called an STR down in Nashville. And I got like a $20,000 deduction this year that I can use to write off against my ordinary income. When the government says tax the rich, they're lying to you. They don't tax the rich. They tax your ability to get rich. And there's 3 ways that the IRS incentivizes us to use our money. Number 1 is business. They're going to give you tax incentives to use business. You get deductions. It's a completely different tax world as a business owner compared to a W-2 employee.
Right.
They don't reward lawyers or doctors making $800,000 a year as a W-2. They're not rewarding you. You're paying a massive tax bill. They almost need to do the rental property to offset the ordinary income, which I have CPAs that, they explain this really well. But they tax my ability to get rich. So business owners are number 1. Number 2, the IRS incentivizes real estate. They want the consumers to take risk to provide places for people to live, work, and shop. They incentivize us to do that through tax deductions and credits and all that. And number 3 is my family. My life insurance is income tax free to my family. What it does create is an estate tax, but that's right now it's like over 20 million. So it's not really a big concern for most people. That's a story for another day. Yeah. So syndicates are great because you get your hands wet, but you're not like super responsible.
Do you get any appreciation? No, appreciation. Like the property value goes up, do you get?
Yeah, bro, 100%. So all the cash flow, I get the cash flow and the appreciation. So our project, it took longer for us to get approval from the city to actually rent all the units. So the cash flow wasn't there in the first 12 months. It was just enough to keep the debt paid for. And so what I mentioned before is that real estate right now is really an equity play. And so the property since we started until today is up 20%.
Okay.
So my $100,000, if it sold for 20% more, I would get a 20% on the 100,000 at the sale. And then I would have about 90 days before I have to roll that over into a 1031 or another rental property. And then I don't pay tax on that growth. Right.
Is there an exit strategy? Is there a requirement or is it sort of liquid somehow? Your 100,000 of equity.
So if the property sells, all of the investors are paid out. And then I have
who decides when to sell?
Well, that's a good question. They do. I probably could vote, but they can pull the strings because I'm not in charge.
Yeah, so that's a downside, but I'm not saying that's not worth it.
We're allowed to talk downsides. This is objective education, right? Yeah, that is a downside. I'm not, because I'm also not the one finding the renters. I'm not the one who furnished the place. I'm not the one who dealt with all of that. So if they want to sell it, cool. Hopefully we can sell it again. And I make so this is why I love it, dude, because my retirement plan can pay me cash flow before age 59 and a half, and I get equity before age 59 and a half. And ideally, I owe no tax on any of it because of the depreciation and the 1031 laws.
Okay. Looks good.
I'm going to make a t-shirt with a back that just says buy, borrow, die.
Oh yeah, I've heard that before. Is that you? Did you come up with that? Buy, borrow, die?
For the sake of this, yeah, let's just say that I came up with it. Sure. Yeah.
Oh, okay.
uh, but the idea is, when Elon Musk bought Twitter, do you think that was after-tax dollars that he bought Twitter with?
Probably not.
No. Here's the storyline. I want to buy $500,000 house. If I were to pay cash and do what Dave Ramsey says, if I buy a $500,000 house, I have to earn a lot of income. I probably have to earn about $800,000 to $900,000 of income, pay the taxes due on the income, take the after-tax money, and then go buy the property. And now I own property with no liquidity.
Yeah, it's true. Yeah.
I'm debt-free and broke.
Yeah.
The difference would be, what if I went to a bank and borrowed $500,000? There's no 1099 on a loan.
Right. Yeah.
Debt is tax-free. That's why it's my second favorite four-letter word. So I don't have to earn the income. So when I start buying, when I realize debt helps me get ahead, I don't want to be over leveraged and borrow too much money. I want to make sure that I'm solvent and I can satisfy the loans. That's why cash value life insurance does such a better job as a holding tank instead of a bank. I get all the protection. I get death benefits for the fam. I get good growth. The IRS doesn't tax the growth, and I can leverage it to go buy more and more real estate, where the IRS then is again incentivizing my moves, and the cash flow that I earn goes where? Right back into the policy, so I can go out and buy more real estate. When people say life, and here's another thing, life insurance is not an investment. It's no fixed product. It's a holding tank that protects my assets and my family and allows me to use over and over again on stuff that I want to go do.
Yeah. I almost said that before you said holding tank.
Yeah, holding tank.
Holding tank.
And so when I buy assets like real estate, I want to borrow against those assets, because if I have a loan on the property, that doesn't affect the value of the property. The property can still go up with the real estate market. And there's tax due because I'm not realizing the gain. This is why people think a 401k is so great, because there's no tax. Well, there is tax. You haven't taken receipt of, or ownership of the money yet. Of course, you haven't paid tax on money you can't touch.
Excuse me. Yeah.
And then when I die, the IRS knows what they're doing. There's what's called a step up in basis. My kids inherit property at the value of whatever it is in the day that I die. They don't owe tax on the growth.
That's a huge deal.
Bro,
yeah.
The 401 cottage becomes a legacy thing that my grandkids can enjoy, hopefully.
Who wrote the 401 cottage? Did you? Nice. Okay.
Yeah. 401 condo down in Florida. I'm from Michigan, so we have cottages up north.
All right.
Buy, borrow, die, baby.
That's good. Okay. All right. So Brock Fortner, that's sort of what he's doing, huh?
Brock loves real estate. He's got his own little real estate company.
Huh.
I don't know what he's doing. He's got all sorts of deals that he's working on the side with a number of investors. And yeah, he's got cool stuff going on.
Well, that's good. Okay.
I'm going to give you an example now of how life insurance works.
Yeah, that's a good example. Okay.
I'm going to pull up an illustration. So I'm going to go ahead and stop sharing that.
Okay.
Pull up this illustration to give you a really good idea, because I'm going to prove to you that life insurance is not an amazing rate of return. How exciting is that?
That's pretty exciting.
But what I'm also going to prove is that it's a hell of a holding tank, so that I can go get a better rate of return and protect my assets. Explain how these policies are designed, but let me just kind of quickly go over it. So for anybody listening, we have other videos that explain what this premium is made up of. In short, the base premium is 10 grand. That goes by the death benefit. That's what's due every year. From 10 to 40,000 is called a paid up addition. And I'm doing the paid up addition rider for 7 years. And in the first year, I'm doing a first year dump in of an extra $60,000. So it's $100,000 going in the first year. Yeah. And the IRS says this is not an investment. You have to treat this as life insurance. So we have to put a term rider on that, on top of it. So the extra $1,007 goes to buy an extra death benefit to make this qualify as life insurance and make sure that it's not an investment.
Is that the corridor rule or whatever?
Yep. Yep. So when I stop overfunding the policy in the PUA rider, I also drop the term insurance. So you'll see the death benefit go down in year 8 because I don't need that extra death benefit. If I chose to keep it, I could. If I wanted to pay, the $40,000 longer, I could. These are super flexible.
Okay.
So my $100,000 turns into how much in cash value in the first year?
87,800.
87,000. I have access to about 96% of that in as a loan or as a surrender. I can just take the money out like a bank. So the difference of the 87 to the 101 really just bought me a nice death benefit for the family.
Right.
Okay. Next year, I take 40 grand of my after-tax dollars in my bank account and I put it into life insurance. What does my life insurance grow by?
40,000. Oh, well, your cash value grows by 40,000.
Yeah. Exactly. The cash value has grown by 40. So I'm basically recreating the bank inside of a life insurance contract.
Yeah.
Next year, 40,000 goes in. Now I'm starting to see growth on my cash. My cash on cash return is positive in year 2, it looks like in this example, year 3. And so in year 7, I go, look, I don't want to keep overfunding it because the PUA rider just shows up in cash. It's not earning me any dividends in that year. So I'm going to drop the premium to 10. Lance, what's my cash on cash rate of return in year 8?
Let's see. Well, so 64, 74, 13,000.
You made 13 grand. 10 grand deposit turned into 23 grand of cash value. My cash on cash rate of return.
23. You're right.
My cash on cash return year 8 is a 230% rate of return.
Yeah. Okay.
Now, that's pretty good. Is a bank giving us that when I make a deposit at, Bank of America?
No,
it sure isn't. This is why I want to replace the bank and use life insurance, because that cash value is off the radar of creditors. It's off the radar of the IRS, bought me a big death benefit. And as I make a deposit over time, it's compounding. And this will spark some negativity, and I don't care because this is the way I believe. I believe if your account can go down, you're not compounding. So if your money's invested in Wall Street, you can have losses. It's not compounding. Life insurance can't go down. It literally compounds forever. And so designing these policies really starts to come down to what is somebody making in their own little economy. And then we design it the way that we want, knowing that I want to eventually minimize my premium and maximize the cash value. Because in this example, down at age 66, I'm not putting any more money in and I'm getting $40,000 of growth tax-free every year, no market risk. And so this cash value column becomes my investment capital for all of the stuff that I can control, like a 401 cottage.
Yeah. Okay. Yeah, I guess there's so many different ways to design this. I've been exposed to the 10 pay. What would be I guess the advantage of this is that first year infusion of a high amount gets the ball rolling.
It gets the ball rolling. It kickstarts the cash value. So if somebody has the capital sitting in the bank, yeah, it's wonderful. I've had presentations with people that go, man, a lot of entrepreneurs don't trust the market. They just keep money in the bank. Well, they're losing so much value just with inflation.
That's a good point. Yeah, you could probably convince them or get them to realize that they're losing value.
Of course. Nothing is going to do better rate of return than their business. And I don't want to take their cash and invest in somebody else's business on Wall Street. It just doesn't make sense to me.
That's a good point.
I would like the idea of having their savings account replaced with life insurance if they give a crap about their family, and then leverage the cash value to go buy things that they can control and enjoy. If you're an entrepreneur, you value your time. So a 401 cottage idea is very attractive to somebody who has a family that wants to be able to take their kids places and have the IRS incentivize everything.
Yeah. All right.
Thank you, everybody, for watching the first Wealth Wednesday with Cashflow Architects. I'm Matt Love. Make sure you leave a comment below if you have questions, thoughts, disagreements. That's all good. We welcome everything. Let me know your thoughts in the comments below, and we'll see you next week.